Hello everyone, and welcome to my second video on ratio analysis. In this video I'm going to be taking a look at the gearing ratio and what that means for business. Okay, what gearing is it's the long-term debts of a business as a percentage of the capital employed. So in other words, it's the percentage of the business that is funded by long-term debts. The higher the gearing ratio, the higher the percentage of debt that this business is in. And it's calculated by this non-current liabilities over capital employed times 100. Now, in order to be able to do this, we need to first of all know what our capital employed is. Capital employed is essentially all of the money or capital which has been used in the business. And it's calculated by the total equity plus the non-current liabilities. In my previous video, when we were looking at the balance sheet, we said that the total equity was all of the owner's funds and the reserves that the business has. And that is true. It's all the money that's gone into the business. But we also need to include the business's long-term debts. So the business's long-term debts are its non-current liabilities. So if we add in our total equity and our non-current liabilities, we have all of the money that has gone into the business in order for it to function. So we take our total equity, which was £7,100 million, plus our debts, so our non-current liabilities, our loans and mortgages, which was 17,300, and we add the two together, which gives us 24,400. So that's the business's capital employed, all of the money that has been used by the business in order to function, both from its reserves, from its share capital, and its long-term debts. Okay, so now that we've got this, we can use this number to help us calculate what percentage of the business is funded by long-term debts. So we use this equation here, so we take our non-current liabilities and we divide them by our capital employed and then multiply by 100. So we've taken our long-term debts, very much the same, so 17,300, and we divide it by our capital employed, so 24,400 million, and then times 100, which gives us 70.9%, which means that of all the capital employed that goes into this business, 70.9% of that is long-term debts. So the business has borrowed a significant amount of money in order to function. So we now need to interpret this statistic. So a business which has a gearing ratio, such as this one, which is above 50%, is considered highly geared. And if you are highly geared, there are many problems that are associated with this. It means that you have potentially high interest payments. If money has been borrowed, it's from the bank will expect a return on that. So that might be something that's eating away at the profit of the business if they've constantly got to put out financial payments or of interest in order to cover their debts. It also makes the business look much more risky to investors. They might see that debt and be like, "Oh, I don't really want to take that on." So Rover, for example, were once upon a time sold for £10, which was basically the cost of the paperwork, because they were in so much debt that they could only sell it for the cost of the paperwork. Effectively, the company was given away because their debts were so high. Certainly investors would be very concerned to take on a business with high debt and a very high gearing. The other problem is, if this business wants to expand, it cannot do so by taking on more debt. If a bank sees that they've got a 70.9% gearing or a high gearing of above 50%, then it's possible the bank will just say, no, we think you've got enough debt as it is, deal with your current debts before taking out any more money. So that's some problems with being highly geared. We have the other end of the spectrum though. We have possibly a business could be lowly geared. So at 25% or less, a business is considered lowly geared, which means it will not have big interest payments to paid. However, we could consider that perhaps there is opportunities there that the business is not taking advantage of. It has a large number of assets and things which it can use as collateral in order to take on more debt in order to fund its expansion. So being lowly geared is not so much of a problem as an opportunity that's not being taken fully. The opportunity is not being fully taken. It's not using all of the capital available to it in order to expand. Usually businesses, a healthy level of gearing is between 25 and 50%. So if you want to improve your gearing, if you're perhaps highly geared and you want it to be less geared, what you could do is sell shares. But potentially that has a lot of problems because although you're getting in money in which you can pay off your debt, you might have to pay off dividends in the future or pay dividends to shareholders, which potentially could eat into your possibilities for reinvesting that money or may lower the dividends of existing shareholders. You could sell some assets, might be a thing. Or look to use retained profit in order to pay off non-current liabilities in the future. So this is a useful statistic when considering a business's investment options. So I hope that's been useful about what gearing is, and see you next time.